welcome everyone to the final segment of UBT Journeys Smarter in September series. You know, I'm Kelly Robert, and I manage the Journey program here at UBT. Journey offers opportunity for education, enrichment, and entertainment for our customers and their friends who are lucky enough to be over 50. Today's segment happens to check more than one of those boxes. It's right-sizing for your future, finding and funding your perfect fit. And we get to a place in life where we don't really know the home that worked well for us before isn't working now. And golly, where do you even know where to start with that? So our experts are all well respected in their field, and they're going to offer some insights. Our presenters, again, I can't say enough about them, are Tami Wolford and Mariana Hunt from UBT's home lending area, and their friend and colleague, Doug Hanna, who's with Home Realty. UBT is just synonymous with customer service, and those with whom we associate are too. For that reason is we believe in setting the gold standard in customer service. Our home lending area is no exception. I think you're going to be so impressed with Tami and Mariana and the level of knowledge that they bring to this presentation. And Doug has carved out, Doug, you've carved a very nice niche for yourself through the real estate market, haven't you? By recognizing the needs of folks our ages.
Yep.
Yeah. I'm just so thrilled to have them here. Tami, you've been in home lending for a couple of decades now.
A long time, yes.
A long time. And she's been here at Union Bank for a very long time. She has growing daughters, and I think that she can probably tell you a little bit about her firsthand experience with deciding that your current home is just not your current fit. So I'm going to let Tami kick off the presentation today, and I just welcome you again. Tami, Mariana, Doug, welcome and take it away.
Well, thank you. Good afternoon, everyone. My name is Tami Wolford, and my husband Brian and I are empty nesters. So this is a topic that I can really relate to. We actually did downsize, and so I've been through this process myself. And as you prepare for the next season of your life and consider whether to change properties, buy a second home, or invest in income-producing properties, there's a lot of things to think about. In this presentation, we will be discussing the right fit for you. That might include upgrading or downsizing your current residence, what you need to do to prepare to buy a new property, the types of financing available to you, and the changes in the loan process that you should be aware of. If you are considering downsizing your current home, you need to think about, what does my next step look like? Is it a single-family home, townhouse, patio home, or even a condominium? Does it make sense with what interest rates are and the price of homes? Does it make financial sense for you? The good thing on a primary residence is you will have the lowest down payment requirements. You'll get the best interest rates available, and there are no reserves required. And I'm going to handle reserves and talk about that in a minute when I talk about different types of properties. The other thing to consider is maybe you're not downsizing. Maybe it's time to buy your dream home, to expand before you step into that next stage of life. So it is easier to qualify for most people before you retire because your income typically goes down in retirement. So this might be the perfect time to consider buying that bigger home. Condominiums, if that's your next step, that is a very unique type of transaction and unique type of property. Both the condominium project and the borrower have to qualify for secondary financing. It does require one or two types of reviews. The simpler of that is called a limited review, and it requires a 10% down payment. That will involve less documentation from the homeowners association, and it's an easier review to get through. If you don't put 10% down on the home, then you're going to have a full review, which includes the budget, the bylaws, the covenants. They look at the homeowners association for that condo project and see if they have enough funds to handle deferred maintenance. We even have to have a Fannie Mae consultant review the project and approve it. So that is a much more difficult transaction to get through, excuse me. They will, in either situation, look at the percentage of investment properties in that condominium project, the limited amount of commercial space that they will allow. There are no daily rentals allowed to be advertised, and one owner can only own a certain percentage of those units. So that there's a lot of documentation that has to be reviewed by underwriting for a condominium. If you're looking at buying that as a second home, you will need to put 25% down instead of 10%. For a traditional second home, single family home, you can put 10% down on that home. But it does require reserves. And I mentioned reserves earlier. And what that is over and above the cash that you need to document for the down payment and closing cost, you have to have liquid assets that you have access to. You're not going to use them, but you have to prove that you have access to them for 2 months of the monthly payment on the new property, held in reserve after closing. Some people look at investment properties as a way to supplement their retirement income. And the lowest down payment available on investment property is 15%. However, the interest rate at that down payment is significantly higher, and it will require mortgage insurance. So it's going to be a lot tougher to have that property cash flow because of where the interest rate is going to be on that and where the monthly payment will be. There is a significant benefit for putting 25% down on investment property because you're going to get a much lower rate, and that property is going to cash flow much better for you. When you buy investment property, the reserve requirement is higher than on a second home. On a second home, it was 2 months of the monthly payment. On an investment property, it is 6 months of the monthly payment, including taxes, insurance, and association dues for the subject property, the property you're purchasing. And if you own additional investment properties and you have them financed, there'll be additional reserve requirements over and above that. One thing that will help you when you buy investment property is that you can have the appraiser do a market rent analysis, which is a projection of what that property would lease for, or you can use a 12-month lease, and you can use 75% of that figure to offset the payment on the new property, the new rental property. You can't get additional positive cash flow from that, but you can offset that payment with that. So those are the items that I am covering today. So it's now my pleasure to introduce my colleague, Mariana Hunt. And I'll tell you a little bit about Mariana. Mariana is an assistant vice president and mortgage lender here at Union Bank. She has over 17 years of banking experience, of which 15 of those have been with us at Union Bank. Mariana has served on many boards through her years and works with the community through the Food Bank of Lincoln and the Heartland Cancer Foundation Board currently. She's passionate about helping others achieve their homeownership dreams and making the process seamless as possible. When she's not at work, Mariana loves chasing around her 2-year-old son and traveling the world with her husband.
Thank you, Tami. So what I will be talking about today is preparing to buy the new property that you envision. And the biggest takeaway that I want to leave is that timing is really going to be key when retirement is in the near future, but you're thinking about that next property. You really have to be careful as far as, okay, how do I set that up? What is that timeline's going to look like? Because it can really impact your financing options. So the first thing that I want to talk about is when to notify your employer. So when to give notice, when to kind of hold off on giving the notice if you know that retirement is nearing. As soon as you give that notice to your current employer that you want to retire, that you're going to retire, that income is no longer usable income for the loan process. And the reason for that is the lender will go ahead and do a income verification with your employer. And if they go ahead and share with us that, hey, they have notified us that they'll be retiring at the end of the year or by X date, then we see that as that's not going to be continued income, so we can't use it for the loan process. So again, just have to be very careful as far as how that domino will fall in line and when to communicate certain changes with your employer. The other big thing is going to be, if you are counting on getting retirement income once you retire, that's great, but there might be a waiting period before we can use that income. If it's Social Security or pension, we are able to use that future income as long as your first mortgage payment as long as your Social Security or pension payment begin before your first mortgage payment is due. Meaning you would have to close on your new property about a month or two before your Social Security or pension income begins. So if you're thinking, oh, I'm going to give my notice, but I'm not going to retire for another year, but I really want to buy a house now, then that's going to impact that because now you're not going to be able to buy a house for a year or at least a couple months before your pension or Social Security kicks in, unless you have another source of income aside from your employer income. The other thing that you can do is if you're of retirement age, meaning 59 and a half or older, then you can set up recurring draws from any asset account for an income stream that we can consider. But again, it's not allowed unless you meet the retirement income or retirement age, I apologize. Some of the different financing options that are very popular, bridge loans. I'm sure most of you have heard of a bridge loan and maybe have taken advantage of that in the past. There's a couple of different options that we offer. We have your traditional bridge loan, and then we call cash to close. It's very similar. Think of it as a home equity loan. So your traditional bridge loan essentially is a temporary loan that finances the purchase of the new property and allows you to not have to sell your existing or current home until later on. So it's a great option. The cash to close essentially is allowing you to get your permanent mortgage to purchase the new home, but then also at the same time get this cash to close or home equity loan to cover down payment, closing costs, etc. So it's a smaller loan. Again, it's a temporary loan until you sell your existing home, and then that gets paid off in full. There's some cost variation between the two loans, which again, they're both great options. The bridge loan, the traditional bridge loan, is a little bit more costly because there's two appraisals involved. An appraisal done on your current home, your existing home, and then on the new property that you're purchasing. Versus the cash to close, since the only collateral we're taking is your existing home, then there's only one appraisal needed if one is needed at all. Timing, again, is going to be always key when it comes to buying a house. The more proactive you can be, the better off you're going to be, the more options you will potentially have as well. So these type of loans, they're not something that you can just walk in and get closed the next day or even in a week. We're talking 2 weeks, and that's pretty fast. 3 to 4 weeks typical for the turnaround on those loans. Another option available for a lot of folks is going to be a cash out refinance. And this is going to be for unique situations where maybe you have plenty of equity in your existing home, and for whatever reason, the property you're trying to purchase maybe doesn't qualify for a traditional mortgage loan. So what you can do is dip into the equity of your existing home, get a cash out refinance to essentially finance the purchase of the property that you're trying to purchase, because then we're taking as collateral your existing property versus the subject property. With a cash out refinance, you can go ahead and get up to 80% of the appraised value with no mortgage insurance, or you could go up to 90% if needed, but then there's a little bit of mortgage insurance involved. And as far as interest rates, there's going to be a big difference between if you stay at 80% or less, or if you jump up to 90%. I did check rates on that earlier today, and the difference between the two, if you stayed at 80% or less, was 6.25%, versus if you went up to 90% and went all the way up to 7% plus mortgage insurance. Cash out refinances are also going to be 30 to 45 days to close. So again, being proactive and timing is going to be key as well. And then as far as rates, as discussed, obviously the loan to value, the loan amount, and then credit score, like any other loan, are going to be huge factors in determining what rate you get for that type of loan. Down payment requirement. So that's always going to be a variable. It's going to be based on the property that you're purchasing, whether it's a single family dwelling, a condominium, etc. And then also the type of loan as well. So there's conventional, there's your FHA, etc. Something that's very popular that comes up a lot when helping folks into that next chapter is, deciding between a 30-year term or a 15-year term. And you'd be surprised at sometimes the interest rates truly not being that different between the two different terms. I think years past, the 15-year had such a significant advantage as far as interest rate goes. But as of late, there's very small difference, or they're about the same. And we've even seen in recent years, sometimes the 15-year rate is higher somehow than the 30-year. So always talk to your lender, see what makes sense. But the biggest thing when determining if you want to go with the 30-year or 15-year is going to be that cash flow. Right now, if it's before you retire, the 15-year might be super doable, slightly lower rate, so you want to take advantage of it, and the payment's doable. But let's think about 5 years, or maybe less than 5 years once you are retired. What does your income look like, and will you still be able to afford that higher payment at a 15-year rate? No prepayment penalties. So we always say, if you want to double up on your principal payment and get a 30-year loan, but pay it off sooner, whether it's 15 years, 20, or sooner than that, you can certainly do that and save a good chunk of money that way. But that way, at least in case of an emergency, you're not tied to a higher payment by going with a 15-year versus a 30. But again, it's a very personal choice. And the other thing to think about too is how that higher payment, if you go with a 15-year, can potentially impact your borrowing power in the future. So let's say you have that higher payment for a 15-year mortgage established, and all of a sudden you have the need to purchase a new vehicle. Well, maybe that's going to impact how much of a vehicle payment you can afford because you have that slightly higher mortgage payment. Whereas if you had the lowest payment with the 30-year, it could increase your purchasing power for any other lending needs down the road. And then I also wanted to touch base on changes to the home process. So I don't know how long it's been for all of you since the last time you bought a house, but it never fails every once in a while. And I help someone and it's been 15, 20 plus years since they last bought a home. A lot has changed since then, especially since after 2008. A little bit more paperwork, that's for sure. I'm sure Doug and Tami can attest to that. But some of the bigger recent changes that I wanted to really touch base on, the most recent one really is this first one regarding buyer's compensation agreements. So as of about mid-August or so, there was this new law in place in real estate, new rules regarding who pays for realtor compensation. So essentially, that might increase the amount of money that us as lenders have to verify from the borrowers. So we always advise in this case, talk to your agent if you have a buyer's agent. Please talk to them, see how that might impact what the agreement will be, and then communicate that with your lender so that we make sure when we are pre-qualifying you that we know you're going to have enough assets available to avoid any issues down the road when closing on your mortgage loan. So talk to your lender or talk to your real estate agent about that for sure. Verification of employment and credit inquiries that we do. So not only are we verifying everything right off the bat as soon as you're under contract, we do third-party verifications with your employers. Obviously, we run credit at the very beginning as well. But what some people don't realize is that it's not just that one time that we check and then we're good to go. Days before the loan closes, we have to verify those things again to make sure you're still employed, you're still making the same amount of money, working the same amount of hours. And then we're also just checking your credit. It's not a hard pull, not a hard inquiry. We're just checking for inquiries. Have you applied for any new debts, any new credit cards, any new loans? Because if you do have new additional debt, that will impact your application, that will change your application, and could potentially affect if we can close on your loan or not. So something to be aware of. Sometimes people just think, oh, they already verified at the beginning, I'm going to start my new business or I'm going to retire soon. And then that can impact that loan closing at the very end. So always consult with your lender before any big changes, that's for sure. And then the last one I really wanted to touch base on as well is homeowners insurance. If you're currently a homeowner, I think we can all agree that homeowners insurance has really skyrocketed this last year, unfortunately. So there's been a lot of changes with homeowners insurance lately with coverage and everything. And when it comes to having a mortgage loan, it used to be that you only needed coverage for either your loan amount that you had or the replacement cost, whichever was less. Well, that's not the case anymore, unfortunately. Now, full replacement cost is required. They don't take, we can't use depreciation into account for that. So that can really increase the premium that you're paying that's required if you have any financing in place for your home. So something to keep in mind and consult with your insurance agent and get a few quotes. Always better to get a couple quotes to kind of shop around and see what your options are. But that's a big change that I think if you haven't owned or if you haven't financed a home recently, that can definitely impact that monthly payment. So that is all that Tami and I had as far as the actual lending side of things go. Up next, I have the honor to introduce Doug Hanna. And Doug Hanna is going to talk about planning for the tsunami. And just real quick about Doug. So Doug Hanna is a realtor with Home Real Estate, and he has served the Lincoln home buyers and sellers for over 47 years. Specializing in residential sales, Doug's client-focused approach to real estate has earned him a people-friendly and professional reputation throughout his career. So Doug, take it away.
Well, thank you everybody for being with us this afternoon. We appreciate your time and your attention. And it's my understanding that a good portion of the audience today is made up of my fellow baby boomers. So I'm always happy to spend time with folks from my generation. So thanks for being here. So yes, my topic is planning for the tsunami. Now, how many of you have really given much thought to tsunamis? Do you feel like you're really prepared for the coming tsunami? And you're thinking, what is this guy talking about? We live in Lincoln, Nebraska. What's this talk about tsunamis? Well, it's obviously not a real one, but there is a tsunami heading our way, and I'll tell you about that as it relates to real estate. So in my industry, we refer to that as the silver tsunami. And what do we mean by this? Well, in the year 2030, which is not that far away, the last of the baby boomers will be reaching the age of 65. So what's the significance of this? There will be a total of about 73 million retirees at that point who will either need to need to downsize or want to downsize from their present homes. So let me put that in perspective for a second, because it's a big number. So according to the National Association of Realtors, go back to the year 2000, and out of all the homes that were sold in the year 2000, 22% of those were people downsizing. Now we fast forward to last year, in 2023, the study done by the National Association of Realtors said that that number of people who sold their homes last year, a whopping 45% of them were people who were downsizing. It's a very significant number. And this will continue to be a growing trend over the years. So with that in mind, the topics that I would like to cover with you today are the reasons for downsizing, the different housing options that you may want to consider, and how to best prepare for this transition or this silver tsunami. So let's talk about reasons for downsizing first. It's been my experience to work with my clients over the years that there's three main ones. We'll talk about some other ones, but the top three ones are the need to change your floor plan from what you're currently living in. The second is escape to warmer climates. The third one, and maybe the most powerful one, is relocating and downsizing to be close to grandkids. It's a very powerful draw for a lot of people that I'm sure you'll be able to relate to. So let's talk about the reasons for downsizing as far as the floor plan is concerned. You may be in a property that you've raised your family in, and you may have 3, 4, 5 bedrooms and three bathrooms and lots of steps and way more square footage than you're even living in. So you may want to be considering something all on one level, where your primary suite is on the first floor, your laundry room is on the first floor for convenience. You have a lot less steps and a heck of a lot less square footage to deal with and to clean. So that's one of the reasons for downsizing, new floor plan. The other one would be escape to a warmer climate. Now, we all dearly love our state of Nebraska, but as we get older, those Nebraska winters are getting a little less fun all the time. So we have a lot of people who are considering moving to warmer climates, either full-time or at least part-time to get away in the winters. So we have people who want to invest in a second home or just rent for the winter. My advice is to, if you're considering doing this, moving to a warmer climate, is really familiarize yourself with the market. Kind of shop around and decide, do you want a townhome? Do you want a condo? Do you want to have a smaller single family home? But really familiarize yourself with the market. And it's also my suggestion to my clients, if they're considering this, try to think of this as kind of a temporary thing and rent before you actually invest in a place. I've had a lot of people where they go to and they just really want to get a sense of what the community is like and if it's a place that they want to stay at for years to come. I've even had some clients who, I think this is kind of interesting, well, they'll take every winter, they'll go to someplace else. So they may, one couple in particular, they've gone to Tucson one winter, and then they'll go to Palm Springs, and then they'll go to Jupiter, Florida, and just check out a lot of different places so they can determine where they feel most comfortable with. Now, the third motivator, and like I say, perhaps one of the biggest ones, is when people downsize and relocate to be closer to grandkids. And I'm sure a lot of you can relate to that. We don't want to miss out on our grandkids growing up. We don't want to miss out on those school activities, those sporting events, time spent with grandma and grandpa. So I've seen a lot of my clients move clear across the country to be close to their grandkids. So the side benefit of that would be that if you do that, then as we grow older and we need more assistance and more services, we've got our family right there. Our kids and our grandkids are there to help us. So the next reason I would like to talk about as far as downsizing is the ease of ownership. A lot of my clients at this stage just say, Doug, we just want to simplify our lives. I hear that a lot. And so a lot of times people will consider a townhome as an easy move because they want to get rid of the snow blower. They want to get rid of the lawnmower and let those chores left to somebody else. So they, especially if they decide they want to do more traveling at this stage in their lives, it's nice just to be able to lock the door and take off. Then we come to the option of assisted living as another possibility. Now, us baby boomers, we all think we're going to live forever, right? Well, as time goes on, we know we're going to need some assistance, and we know we're going to need some special services. So, going to an assisted living may be a nice alternative for a lot of people. And in Lincoln, we're very, very fortunate. We have a lot of tremendous assisted living communities to choose from. My advice is to, if you're considering that move, my advice is to really check out several of them. Take a look at the cost of the services and what amenities each one has, what services do they provide, and just an overall feeling of what this environment of this place gives you, and if you feel most comfortable with a certain one. So another thing to consider, if you are considering assisted living, some places have a graduated care facilities. So you may start out by have an independent living apartment, and as time goes by, you may move into the assisted living area. There's some communities that offer memory care and also skilled nursing. So that's something you may want to keep in mind too. So those are some of the reasons for downsizing. And so what are our options? Okay, so we've already touched on a couple of these, but townhomes is kind of a go-to, moving from a single-family home. A lot of people like to consider a townhome as their next move. Again, in Lincoln, we have great alternatives, and we have townhome communities in a variety of different price ranges to choose from. It's always important, if you're considering a townhome, to check out what their homeowners association dues are, the HOA fees. These often, cover your lawn care, snow removal, garbage service, recycling, maintenance of the commons, and sometimes exterior water. I find in Lincoln that ranges from about $100 a month on the low side to probably $250 or $275 on the high side. So be sure to check out what the HOA fees are. Now, condominiums is another option. I've had some clients who really want to embrace the lifestyle of living in downtown Lincoln or wherever you happen to be moving to. They want to take full advantage of the theaters, the restaurants, sporting events, art galleries, farmers markets. So they really want to immerse themselves in that lifestyle. So if that's something that appeals to you, again, you'll want to check out the HOA fees because they tend to be higher than even the townhome communities. Because they provide more services. Usually included in that is your phone and your internet, building maintenance, building insurance. Some condo communities also offer a gym or a workout room, in-home theater, party room that you can rent out, and those kind of things. So the fees are a little bit higher. Another alternative would be a patio home. So if you're not familiar with what a patio home is, it's kind of a hybrid between a single family home and a townhome. So a lot of people consider this to be actually the best of both worlds because you have the privacy of a single family home, but you also have the convenience of having an HOA take care of the lawn care and snow removal. And the HOA fees are typically similar to what you would find in a townhome community. If you're not familiar with patio homes, there's a good example here in Lincoln. It's an area that I was involved in helping develop about 25 years ago. It's called Taylor Greens. And where that's located is it's kind of nestled in between Taylor Meadows off of 66 and A Street and Taylor Park neighborhood, which is off of 66 and O Streets, kind of right in the middle. So if you're curious about that and you want to see what a patio home community looks like, it's right off of Haverford Drive, and you can check it out. It's a beautiful little neighborhood there. So that's patio homes. Now, if you really want to simplify your life, maybe you might want to consider apartment living. So what that includes, the benefits of that is that you eliminate so many homeowner expenses. such as you don't have to maintain your property, you don't have to pay property taxes, you don't have to pay homeowners insurance, and you don't have to pay HOA fees. So that could be attractive to a lot of people when you don't have those responsibilities. But the caveat would be if you've been living in your house for 35 years and all of a sudden you're moving to an apartment where you're around a lot of people, you're obviously going to be sacrificing some of your privacy. So then we've already talked about assisted living. And another viable option that we're seeing more and more people consider is aging in place. Okay, so I've had a lot of clients lately just say that, Doug, I'm very happy with where we live. Our floor plan fits us, pretty well, and we're familiar with the neighborhood, and we'd really kind of like to stay here if we can do that. And so you can always hire the lawn care and snow removal to be taken care of. But one thing to keep in mind, if you do decide to age in place, you may have to do some retrofitting to your home as time goes on and your needs change. Examples of this would be a lot of times people will take and try to find a place to do a stackable washer and dryer on the first floor, whether it be in the kitchen or a bathroom or a closet that has plumbing access. So that way you're not running up and down the stairs all the time to do your laundry. Another example of retrofitting, if you're going to age in place, would be doing something different with your bathroom arrangement. So we see a lot of people these days take out their soaking tubs and put in a zero entry shower so you don't have the trip hazards anymore. So that's another common thing that we see if you're going to be staying at home. So we've talked about the reasons for downsizing and the housing options. So how do we best prepare for this transition? As you can imagine, being in the real estate business for 47 years, I've had the opportunity to help a lot of my clients go through this transitional stage of downsizing or relocating. And the thing that I have found is that there's two different schools of thought in how people handle this transition. One is to be reactive, and the other is to be proactive. So let's talk about the reactive side first. So it's been said that there's probably around 67% of the people who downsize do this as a result of a health issue in the family. So the problem with that being reactive is that all of a sudden you may have been delivered some bad news about your health or your spouse's health, and then all of a sudden you have to make all these major life-changing decisions. You have to figure out, where are we going to live? Or are we going to go to an assisted living? Or are we just going to go downsize to something else? That's a major decision you have to make in a short period of time. You also have to figure out, what are you going to do with all your stuff? I mean, as baby boomers, we have a tendency, I have found that we collect all these treasures over the years that we hang on to, some of us. And so now we have to figure out how to get rid of this. We also have to be concerned about getting your house ready to sell in a short period of time. So to be reactive, you're under a lot of duress and stress and have to make these major decisions in a short amount of time. So on the flip side of that coin, we have the people who do this proactively. So this group, they're very intentional about their downsizing, and this probably represents 25 to 30% of the people who downsize, really give us a lot of forethought and make some of these decisions along the way so they're not panicked and having to make these major life decisions. So how do we prepare for that? How do you be proactive? So these folks have a tendency to be thinking ahead and really consider the different housing options that are available to them. And so they'll go out and they'll check out, smaller single family homes. They'll take a look at townhomes or take a look at assisted living and really get a sense of where they want to be. And they get familiar with those markets. They systematically thin out their personal property. And so that way they get rid of some of their possessions so they're ready to move. And my wife is always reminding me that I need to be doing this as well. So I can relate to this. And then so a lot of times people get rid of their, thin out their possessions through garage sales or estate sales or simply donating. So it's important to do along the way. The other thing is, making the necessary home improvements from year to year so that when the time comes when you are ready to move, your house is ready to be put on the market. So examples of that would be over the years, you may want to, freshly paint the interior of your home. You may want to change out some floor coverings, some light fixtures, plumbing fixtures, so that you put your best foot forward when you're ready to put your house on the market. So, in closing, we've talked about some of the reasons for downsizing, what your housing options are, and how to prepare proactively instead of reactively. So, the silver tsunami is coming, folks. It's been on our radar for quite some time. Economists are talking about it and the effects it'll have on the market. The National Association of Realtors have addressed it. So it's not something you should ignore, but instead you should make a plan and take the necessary actions and steps to put you in a better position, in a more relaxed position, so you can make this a smooth transition. So having said that, I would like to close with a quote from one of the biggest and best philosophers of my generation, and that is Yogi Berra. So what Yogi Berra says as it relates to this is, if you don't know where you're going, you'll end up somewhere else. So at this point, Mariana and Tami and I would like to open this up and answer any questions you might have.
That was wonderful and so comprehensive. A huge thanks to all three of you. I have opened up the chat feature. Folks, feel free to type your questions in the chat. I have one for each of you just to get the ball rolling. And you can answer however you'd like, panel style or as a group. Tell me, in your opinion, in your professional opinion, what the biggest don't is to your facet of the industry. What are some of the biggest mistakes you've seen?
Sure. Oh, I can take the first one. If you are employed, the biggest don't is do not change jobs. Give notice on your job. Tell your employer you're going to retire in the middle of your lending process, because it changes the entire game. When you go to get any kind of financing on a mortgage loan, we have to reasonably predict that your income is going to continue for a minimum of 3 years. So the minute you make a change, even if you're not going to quit until after you close, the minute you give notice, that income is no longer usable, and so it blows up your transaction. So be transparent with your lender. Don't make those life decisions in the middle of the process. Your life will go a whole lot smoother.
Yeah, I'd like to piggyback off of that. Just communication is going to be key. Communication with your lender, with your real estate agent. I like to joke around that as your home lender, I'm going to find out anyway, whether it's sooner than later. And I'd rather find out sooner from you than at the end and we can't close or we have to delay closing. So communication is key. Don't try to not necessarily hide things, but just be transparent with us and communicate.
And as far as my industry is concerned, I think the most important thing is kind of going back to what I was just saying about preparing, and don't make any knee-jerk reactions. Really give it a lot of forethought before you make major life decisions as far as your housing is concerned. And again, if you're moving to a different market, make sure that's where you want to end up before you commit to investing in a property there.
Good. That's all really, those are great tips, great insight. Anybody have a question for us? Or not for me, but for our presenters? It sounds like there are some, I don't know, would you call that tsunami exciting changes or a terrifying advance?
Oh, I think it's going to be a natural evolution of our market.
Sure.
One of the benefits that I think we will experience. I mean, for years, we've been hearing nothing about the shortage of inventory. There's just not enough houses out there for the buying public to engage in and purchase. And so that's been a common theme for many years now. What I see happening as my generation ages out is that there's going to be more of those homes coming on the market naturally, because those people are going to be downsizing or moving to townhomes or condos or whatever the case may be. So a lot more of those larger single family homes that we raised our families in will be coming onto the market. So I think we're going to have a lot more inventory. The other effect of that will be that with 73 million retirees making this decision to downsize or to relocate, it's going to be higher demand for properties like townhomes and condos. So we're going to see a shift there. So hopefully there's some developers out there who are thinking ahead to build, smaller homes or more condos or more townhomes. So it'll definitely have a shift in the market.
Great. Well, thank you. I don't know about you folks watching. I'm kind of sold on the patio home idea. In fact, I might take a cruise by the property Doug was talking about as soon as I get back in Lincoln.
Oh, if I could also mention, I forgot to mention, speaking of patio homes, there's a new development where the old Knowles golf course and restaurant used to be that they're developing right now. It's kind of on the east side of where the clubhouse and restaurant were. And those are going to be patio homes. They're going to be very upscale patio homes. So that's something to look for as well.
Oh, and that's in a beautiful area.
Very nice
Great.
area. Yeah.
Okay. Well, you have given us so much to think about. And folks, I will make certain that you have Mariana and Tami's information available to you, their contact information, should you desire it, and the same with Doug's, because you're in good hands with these three. And I just can't thank our presenters enough today for their time and information. And thanks to all of you who have given up a slice of your Tuesday afternoon to tune in to our final segment. This wraps up another series for 2024. We'll be back next year with Tune Up Tuesday in January. Stay tuned. Keep an eye on your Journey e-News for upcoming events. Thanks again, everyone. Have a fantastic day.
Thank you.
Thank you.
Thanks. Bye.